Hi, I'm Anne Gannon, and welcome to my podcast, The Franchise Accelerator. As the founder of the Largo Group, I have provided accounting services with a specialty in the hospitality industry over the last decade. I have prided myself on finding a way to work with my clients, not just where their businesses are today, but working with them to scale. What I've realized over the course of this work, this mission, is that the common challenge for business owners is how to scale. How can you go from one location to many locations if there's just you? This is why we've started the Franchise Accelerator, because inside you is a great idea that can scale. And with the right tools, the right techniques, you too can create a franchise, a brand that's more than just you grinding it out, working 80 hours a week, and sacrificing for your business. You can create a brand that can stand alone and can truly create financial wealth for your family. I'm so excited to be a part of your journey, and I look forward to being with you every week as we join on this adventure together. Okay, well, welcome to our episode. I'm so excited to be joined by Josh Cadillac. Josh, thank you so much for taking the time to be here.
It's great to be here with you, Anne. Thanks for having me.
Yes. So what I would love to do is just dive in, because I feel like you have a tremendous amount of knowledge to so much of what is going on in today's environment, from inflation to real estate. So take us a step back and really, I think, as a place to start, give us what you think about real estate right now, because there's so many articles of boom, crash, scaring everyone. Where do you think we are right now in the real estate market?
Well, I think that the run-up in prices that you've seen in real estate is actually to be expected in a market that is so heavily influenced by inflation, right? So what I like to do always when I'm analyzing real estate, because as a person that owns investment real estate and has analyzed a lot of investment real estate, we're always looking to project forward what we think is going to be the returns we're looking at based upon the environment we're going in at. And so when I historically, for the last 30 years, because even though I haven't been in real estate the last 30 years, my father owned a lot of industrial real estate. We always would project, 3.5% rent increases. We project, 3.5% appreciation. Well, we're not using those numbers anymore. The numbers we're using for appreciation and for rent increases are 7, 8, and 9 in some cases, because that's what the rate of inflation is. And one of the things to understand about rents especially is rents tend to go up mirroring inflation, because they're not affected by interest rates. So the Fed could raise interest rates to whatever they want to. And though that raising of rates actually makes the income property more valuable to the landlord, because that is taking options away from those tenants to turn them into the buyers. They can't afford to buy. So as a landlord, I have the leverage now to sit there and say, hey, you know what? The rent is this. What are you going to do about it? Go live with your parents? You got no choice. Right. So that value factor in real estate, that it kind of, at least as an income property, it hedges against inflation, is a really powerful component. Now you have the counteracting force, which has sustained historically real estate through these times where interest rates go up, because when there's inflation, the Fed is going to do their job, which is to try to take and maintain stability in the economy. They're going to try to crush that inflation by raising interest rates. Well, now it makes owning real estate more expensive. So what's the counteracting force that's going to sustain the market from taking a major tumble? Because as we look at a market, it's only made of supply and demand. This is now making the demand have to pay more for the existing supply. So that's got to provide a downward pressure. You have to figure it's going to make it, prices can't go up the same way. And that's a good thing. Prices have gone up a whole lot, and now they're starting to see some tapering down of that. And that should be expected. But the big question that I'm asked all the time in this market is, when is the bubble going to burst? When are prices going to go down?
Yes.
And the answer is, if this behaves like any time ever that we've had and seen a lot of inflation, the answer is never. The answer is the prices are not going to go down. And the example that I give is that the biggest inflationary cycle that we've had in the US, which was the 1970s. In the early 1970s, we made the brilliant idea to come off the gold standard in its entirety. The US dollar was pegged to $35 an ounce of gold at that point. Now, Gold is closer to $1,900 an ounce, in case anybody's wondering how much less valuable their money is today than it was then. But whatever, that's a different point for a different time. So in the 1970s, the interest rate was about 8% at the beginning of the decade. By the end of the decade, in order to get a handle on inflation, it had gone to 18%. So, trivia question, with the interest rates spiking like that, when did real estate prices actually go down? Well, the worst year we could look at was 1982, at the point where we had interest rates of 21%. Wow. Real estate prices still went up 1%.
Wow. Okay.
So if you were on the sidelines waiting from 1970, sitting there saying, the bubble's going to burst, these prices are going to, because the prices went up nationwide 16% at the beginning of the inflationary cycle, because interest rates at 8%, that was homeostasis. That's what people were used to. They're like, well, these rates are good based upon all these real estate prices. And with the projection of rents going up much more quickly and the value of the properties going up much more quickly because the value of money is going down, well, we should absolutely buy. So at the beginning of an inflationary cycle, you always see a spike in real estate prices because investors that see the inflation coming know, hey, look, if I can lock the interest rates in today, that payment is fixed and I'm going to take and have the enjoyment, the true schadenfreude of pleasure of sending the bank back money every single month that's less and less valuable. My rents are going up and my mortgage payment is fixed. Yeah. So that's just taking and enjoying all that extra you're making in that portion of the purchase price that was spoken for in debt service. So I know that was a lot on that, but there's a great
answer though.
Yeah.
Yes. So when you are out advising people, because you speak all over the country to a wide range of audiences, are you telling people then to still look at real estate as a good investment today? Is it a better investment today because of inflation? I mean, what is your stance on, hey, I have money, should I diversify and get into real estate, or should I wait?
Realistically, the big positions, I mean, let's just look at the big players. You got the stock market, bloodbath. Bonds, not doing great. Crypto, getting killed.
Yeah.
Real estate, still going up.
Yeah.
And here's the thing, right? There's so much liquidity out there. Now, some of this is theoretical liquidity. It's just decimal plates in a bank account, whatever. But money has to move somewhere. And there's always this tendency of a flight to quality. If you watch enough investment news, you'll hear this flight to quality. People run to the thing they think is safe. And so gold, a lot of times, is that flight to quality. Bonds, a lot of times, is the flight to quality. Right now, in an inflationary market, real estate is that flight to quality, that thing that you can put your money in. Because here's the other position that we didn't talk about. You could pick any of those other ones I talked about, or you could stay long in cash. Well, here's the thing. When you see that CPI number or the wholesaler price index number come out, understand that's the loss you're taking every single year in your buying power that you now have to go invest to just maintain status quo. Right. In other words, if the value of money is going down 8.6%, which is the most recent CPI number that we have, if you're not making 8.6% on your money, you're losing. So just by staying long in cash, you have to take and absorb that 8.6% loss. The cool thing with real estate is the real estate prices tend to go up to offset that inflation. Now, as interest rates get higher, I anticipate that the appreciation of the real estate won't be as high as the rate of inflation, because this is now applying an additional downward pressure on prices. It's making it more expensive to borrow each and every dollar. But long term, if it's income property, and this is the thing that I'm definitely encouraging my people to do, is to get long in income properties that are generating rents. Because if interest rates go up, it doesn't have any kind of effect on a landlord's ability to raise rents. If the value of money goes down, the analogy I usually like to use to kind of explain this would be, let's say we're going to buy a car and it's a $40,000 car. But we're not going to use cash to buy it. We're going to use shares of stock. So let's say we're going to use GE stock. And I don't know what GE is trading at right now, but I just picked a stock that everybody might know. And let's say it's trading at $40 a share. And this car's a $40,000 car. So we got to give them 1,000 shares of stock to buy the car. Well, now let's say GE falls to $20 a share. The car didn't change. I just have to give them 2,000 shares of GE stock to get the same car.
Right.
And so what's happened is the value of the money has fallen. The real estate itself remains the same. So to get the same piece of property, I have to give them more of these dollars to get the exact same thing. And that's the position that we're in. So as the value of money continues to go down, the real estate still isn't changing. The real estate's sitting there saying, I don't know why the money's going down. I'm doing just fine. I'm just sitting here, just in a house, right? And so the house is staying the same. But with all of this, and you've seen it, I mean, even politicians are out there touting it like it's some kind of a win, that wages are up 4.4%. Way to go. Yeah, but the value of money went down 8.6%. You've taken a net 4.2% loss. Yeah. So the real bottom of what the appreciation can be is the wages, what the wages do. And the top is the inflation number. And between that is typically where real estate tends to ride, somewhere in between those two. Real estate tends to outperform wages some, and it tends to keep pace with overall over the span of time with inflation, and actually outperform inflation a little bit.
Yeah. No, I mean, it's great advice. And I feel like, it's hard. A lot of our clients are, restaurant owners who maybe fell into real estate just because their building came up for sale. So I just bought my building and now all of a sudden I'm in real estate, but I don't really know. But, I think people forget the long-term value of the asset of real estate. And like you said, if it's able to generate income, then 20 years from now, you're going to be so thankful that you have the building, even though, it's a little bit of a stress or a headache today. So,
that's the cool thing with owning real estate, especially if you've borrowed money and, you've baked that debt service into the cake of your overall numbers. That debt service, the cool thing with it is it's fixed. I've been in the restaurant business, so I get it. The other expenses aren't fixed. Right. No. Everything else is going up. The servers want to make more. This is what's hilarious to me. This is really what's funny, right? There was all this push for a $15 an hour minimum wage. It was such a big thing, right? Understand what inflation has done, to be clear, is because money, understand, is a representation of the labor you've done. You exchanged your work for this money as like a placeholder, a posting note that says, hey, look, this person's owed this much of buying power in our economy. By having inflation occur, they have retroactively gone back into the past, looked at the work that you've done, and basically given you a pay cut.
Yeah.
It's nuts, because while you made an agreement to work for this amount of money at this time, that money now can no longer buy what it could have at that point, what you thought you were exchanging your labor for. It's, as my dog likes to say, rough. It's rough.
It's incredibly rough. And it happens so fast. I think the hard thing is, when you look around, you can't even compare your business to last year or 2 years ago. I've been going back to like 19 because at least there was no COVID in 19, but my staff was half the cost of what it is now. My food was half the cost. Like, it's just mind blowing into where you have no precedent to where we are today. So like, what are some of your thoughts in the economy and where it is today? I mean, we know there's inflation. Do you think that that's heading towards a recession? I mean, what are you seeing?
Oh, yeah. No, there's definitely a recession coming. Look, I mean, every time a government has attempted to print wealth in order to make people wealthy by printing money, you always have, well, when you eat a great meal, right? You go to a chef's restaurant, it's a 5-star meal and everything is wonderful. You order the best wine. I got news for you. They're going to give you the bill at the end of the meal, and you're going to have to pay the bill. We're paying the tab. And so if you look at the 1970s, once again, the last time that we radically increased the supply of money the way that we did in order to combat COVID, when you had that, you actually had several small recessions throughout the course of that thing. And the thing that I really look at that made me very nervous on the way out of COVID was that the stock market had this massive run up beyond what values were in 2019. But then I went and looked at the GDP, the actual amount of production the US had. And when I adjusted for the inflation, we weren't making as much stuff as we were prior to COVID. So how can the stocks, which are valued based upon the profits they generate, how can they be more valuable companies if they're selling less stuff? I mean, I know that's like a very poor man's interpretation of big numbers, but geez, wait a second, guys. We were selling 100, we're selling 80 now.
Yeah.
And it's a more valuable company. Maybe I'm just too stupid. I don't know. But for me, that was a red flag right there. The stock market needed a reprice. With crypto, it was very much the same thing. There was a lot of liquidity created, a lot of 30-somethings out there that invested in crypto that were just certain that it will never go down because they've never lost money. Folks, I got to tell you something. In a bull market, that whole method of taking a dart thrown against the Wall Street Journal on the wall and buying that stock, that works. When you're in a bear market, you actually have to know what the hell you're doing to make money. And so a lot of these 30-somethings never really experienced the full pain of a bear market. They saw maybe the housing crisis of 2008 and thought that that's what that looked like. But that was a housing driven. That was an artificial creation of buyers by lenders and by government institutions trying to take and expand the market, which ended tragically. That's not the condition that we're in right now. But that was driven by housing, not by overvaluation and over speculation in securities, and stocks, and things like that. They had the ripple effect because it pulled a lot of liquidity out of the market. There was a lot of money, a lot of wealth that was just destroyed. And so people sold in order to take and make up that shortfall. But this is actually a shortfall, that more of a traditional type of sell-off where securities have been estimated to be overvalued. And I think that's why you're seeing it manifest itself this way. That would be my take on it.
So what do you think happens for the rest of the year? I mean, do you think that it causes a full recession? And, I mean, especially speaking from the fact that most of our listeners are hospitality. I mean, I think it's crazy. When I look at it is the one thing that makes this so unique is that you also have people were closed off for so long. So It's sort of the combining of two forces.
Double whammy.
Yeah. So it really makes it very hard to understand, or predict what we think will happen for the rest of the year.
Well, I mean, I think that the obvious thing, if I may answer the question as directly as I can, the obvious thing is there will be a recession. We will be going into a recession this year. We're well on our way. I think that the thing that has been the saving grace of this sort of has been the number of people that have opted out of the labor market coming out of COVID, which has left this very tight labor market, which is what the Fed is using as impetus to continue to raise interest rates. They're saying, hey, look, while prices are up, which is a very hot economy, there's a very tight labor market. And typically a recession is both a fall in stock prices and excess labor. There's not enough jobs to go around. I think with all the wealth that has been destroyed, both in the stock market and in crypto, especially in crypto, that you're going to see a lot of people having to re-enter the market as labor. And so the hospitality industry being one places where folks have just left and haven't come back. I think that you're going to see those folks have to start coming back because the crypto wealth they had developed, the stock trading system they had that couldn't miss. I think those folks have been hurt badly. Your retail investors have been hurt badly by this thing. I think it's going to force them back to the labor market. And at some point, while we don't have enough labor to meet all the jobs that we have, I think the labor that we have is not suited to the jobs that we have in a large extent. So we have a lot of technology jobs, a lot of these better jobs, and a lot of the jobs that people are going to come back in at are going to be more service related jobs. And I think that market is going to be glutted and you'll have excess labor then. And that is what's going to take and slow the Fed's roll a little bit, because I genuinely don't think, and I haven't thought for quite a while, that the economy is nearly as strong as the Fed seems to behave like it is.
Yeah.
And so that my take on it is that we will go into recession. I fully expect double-digit interest rates on mortgages.
Wow.
If you're a believer in Paul Volcker was the guy that actually finally, after a decade of struggling with the inflation in the 1970s, he finally got a handle on the inflation. His policy was that the Fed prime rate, not the mortgage rate, the prime rate needed to be higher than the rate of inflation. So right now our prime rate is about 1.25 to 1.5, right?
Wow.
Our rate of inflation is about 8.6, which means taking the prime rate up about 7%, 7.5%, which take our mortgage interest rates up even higher than that, because our mortgage interest rates are based on the yield in the 10-year treasury. So that 10-year treasury is anticipatory. That means we'd be looking at interest rates of 15%. Now, I don't know that the Fed currently has the, how mean do I want to be? The technical wherewithal and savvy or the guts to actually do what's going to be necessary. But here's the problem with not doing that. The people that are getting killed in all of this are all the people that obeyed the rules and did the right thing. All of our folks that are on fixed incomes that worked a long time for a company and earned a pension, and those folks on fixed incomes, they're absolutely screwed in all this.
Yeah.
Their standard of living is falling, and it's falling at a very tangible rate every single year we allow this to go on. So if we don't have the will to take and deal with this the way that it's got to be dealt with, and we allow this to continue like it did in the 70s all the way into the 80s, it could be a very difficult thing.
Yeah. No, it's so true. It's something that has to be fixed, or it will only wreak havoc.
Well, the problem is the fixing of it hurts really badly too, because I mean, how many of the service industry, how many of those folks have loans and all this stuff that now they have to go get capital? Well, now that capital's at 12%.
Yeah.
Geez, a lot of ideas come right off the table at 12, like they make sense at 3 or 4. At 12, right. It's like, we're not doing that. No. So the ability of that industry to take and grow and flourish and thrive, any industry, I mean, that's the real cost of this thing, because R&D is really what drives so much of what makes an economy grow, is to make the pie bigger, right? The idea that exists that the pie is only so big and, it's the haves and have-nots is just flawed on its face. The economy, the wealth in the country and in the world has continued to expand as ideas come to market and create opportunities that didn't exist, right? And so the problem with making money more expensive is the very projects that are going to take and drive the expansion of the economy often depend upon the borrowing of money to fund those. And so it has a huge effect on our ability to develop our way out of a downturn like this. Yeah.
No, and I agree. And especially in hospitality, it's R&D is such a part of what we do. And so it's scary to think that would have such a cost and take good ideas away.
Yeah. Or delay them significantly.
Or just make it not worth doing. It would be unfortunate.
Or even worse, if our economy lags behind other developed nations' economy, some other country develops it before us, and we then lose the benefit to our economy of being first to market. I mean, the 4G technology was such a huge boon to the U.S. economy. And talking about, now kind of splitting that with China, what that's done as far as the amount of wealth that it brings in. These things have consequences that are very far reaching. And so, I mean, it's not a doomsday thing. The good news, I guess, is it was a global pandemic. So a lot of the developed world is struggling with this stuff. Some economies much worse than others. Ours is one of the worst of them. There are a few that are worse than ours, but several economies are not having the same problems that we are. So it's concerning.
Yeah. No. So switching gears a little bit, talk to us a little bit about, what you do, that you speak, to groups all over the country. How did you get started doing what you do?
As it turns out, when I was in the restaurant business coming in, I had these beautiful Italian restaurants I had opened coming into 2006. Built one out from scratch from a retail site, and went through all the joys and beauty of that, and retrofitting the parking lot and all the fun things that I'm sure that if your listeners are in this space, their souls are cringing as they hear me say it. I know it. And positive airflow tests and all this other fun stuff. I finished my restaurants and got them up and running in about 2006, coming into 2007. So my timing could not have been worse.
Yeah.
I'm in Florida, one of the hardest hit places by the housing crisis, and liquidity just completely dried up. I mean, there was no money. Nobody was eating out. And so we went from having a beautiful chart of trajectory of growth to, borrowing money to take and survive, because nobody really knew how bad it was going to be at the beginning. And I wasn't paying nearly as much attention then as I do now because, fat, dumb, and happy. I'm just doing my own thing. Everybody, the rest of the economy can leave me alone. I'm just, I'm going to make great food. If I make great food, you make it, they will come kind of thing. Right. Turns out if they got no money, they're not going to come. So, yeah, we lost the restaurants. And at the time my father had been in real estate, and owned a tremendous amount of real estate in New York City, and, had sold almost all of it. There was a little bit left. And I decided, you know what, I know something about real estate because I'd worked with him for years on this stuff. And I realized, when I went to get my real estate license, that I actually knew a lot more about real estate than a lot of people that got licenses did. So that was a little concerning. And, but my big, and I just did a podcast with somebody not too long ago on my podcast, and he was talking about a very successful attorney. And I said, like, what drives you? And he said, fear. He said, I was afraid of making a mistake. I was afraid of looking stupid. And, it was so cool because I've heard that answer before. And I got to say, it's what drove me. I'm making these hundreds of thousands, millions of dollar transactions that I'm facilitating for customers. How can I not know what the hell I'm talking about? Like, how do you fake it till you make it when somebody could really get hurt? Like, there's just no way that's okay to do. So as soon as I got my real estate license and realized what they taught me to get my real estate license had nothing to do with the actual process of doing real estate, I went out to go bolster what I know with whatever I could find. And so, if you ever get an email from me, I've got like alphabet soup out, the yin yang of designations and certifications and whatever else. And I'll be the first one to tell you that's just a crock of garbage. 90% of that stuff was a waste of time. So, at some point, they got so used to seeing me at the association where I would take these classes. They said, man, you've taken so many. And, when I would talk to the education people, on breaks or whatever, you should write a class. So I thought about it and I said, you know what? Because I've taken these week-long things, these multiple weeks. I'm going to write a class that is just absolutely as information dense as I can make. Like, pack as much. Nobody's ever going to say they didn't get their money's worth, right? I want to just take and give folks an excellent price. So I wrote a 2-day class. I'm like, this is my magnum opus. I hated in school. I hated writing more than anything in the world. So I'm like, this is the one thing I don't want to do. And I didn't love PowerPoint either. So I actually sent somebody else the book that I wrote and said, make the PowerPoint for me. So I went to the people that told me at my local association they'd let me teach it, and they weren't taking my calls anymore. And just out of the blue, they knew I had the class, and like now they didn't want to come through. And so it took about a year or two, I think, and I got to teach it in Pensacola, opposite end of the state that I'm on. And they're the first people that gave me a break. And I taught the class, and from then it just exploded.
Wow.
They talk. And as it turns out, I wound up teaching a whole bunch of other places. And eventually my home association, they let me go. And so now I have, from the guy that hated writing and hated PowerPoint, I have the record in the state for most CE courses approved for real estate.
Wow.
I'm up to like 30 something at this point on all kinds of topics, because as it turns out, like as you start to think about it, there's a lot of moving parts in real estate. It seems like it's a simple business, but negotiating. Okay, so I wrote a 4-hour class on negotiation. Not too bad. But wait a second, what about objections? Because objections are a type of negotiation too. So I guess I need a class just specifically about how to handle objections. And how about body language? Body language is a whole subset of negotiation that, as I've gotten more and more involved in real estate and more years doing it, reading the other person, so much more is what I do that makes me successful in negotiations. And I can give you all the strategy from Negotiator 1, and it's all good stuff, but really it's using that stuff with actually, who is this person? I can't tell you how many times you walk in the room, all right, that guy's a smart ass. That guy, you're like, you peg everybody. And so your answers, when you're answering them, I'm not answering based upon the data. I'm answering the player. I'm playing my cards. I'm playing you because I'm figuring out what you need to hear from me in order for you to get the message I need you to get. And so, it just expanded and expanded and expanded. And especially with the stuff on crypto, and that was just got roped into that. Because honestly, I'm not going to lie to you, Ann. Like, I get roped into every class. Like I'm like walking around the street, fat, dumb, and happy. And somebody comes up to me and says, you should really write a class about this. And I'm like, I don't want to. First thought in my mind, I was like, because I keep telling the lady that processes it for me from the state to get them approved in the different states. I'm like, this is the last one. She's like, yeah, I've heard that before.
Sure.
And so the crypto one, I'm doing a podcast with somebody, my broker, and he's like, oh yeah, by the way, he's telling everybody on the podcast, I'm going to this crypto thing this weekend. Everybody should come. And he looks at me and says, you should go. I'm like, okay, sure. I'll go. He said, you should write a class on it. I'm like, well, that's great, but I know nothing about cryptos. You think it's a prerequisite. You should know something about it before you write a class on it, right? And yeah, but that one, especially recently, that class has been just off the charts, super popular all over the country because when I go and I teach it, one of the questions I ask at the beginning is like, on a scale of 1 to 10, where would you put your crypto knowledge? And you'd figure, you'd have a nice even mix between 0 and 2, 95% of the time is where everybody's knowledge is. So I wrote a class that was basically my journey of going from 0 to knowing what I know today, which is kind of like how to know nothing, how to be in the conversation, because so much, it's how I approach investment in real estate classes as well. So much of it starts from the fact that if you go out there and try to find out any of this stuff, it's like walking into a physics 408 class if you've never taken physics before. Like, they're speaking English because you can hear and the in the conversation. But
after that,
like what happened? Like, if you're in law school and you walk into like the 4th year class and you're trying to find the 1st year class, oh no, I'm in the wrong line of work. I got to get out of here. And so if you don't bridge that gap, if you don't build that lexicon of terms so that you can be in the like, oh, I know what that means. People easily get left behind. And that is one thing that to me is entirely unacceptable. I leave no one behind. When I write a class, when I teach a class, it's about the person taking the class. If they don't get it, ask me the question. I will always answer. I give everyone my personal cell phone number at the end of the class. I look, if you're too embarrassed to ask the question, call me, because it's about them getting it. It's not about me saying, my masterful presentation. No, I'm there for them. They took time away from money making activities to be with me. I got to give them a return on that investment or I'm not doing my job. Plain and simple.
Yeah.
So that's
and I think what you do is so worthwhile because it's so hard, I think, as people who are out on their own, entrepreneurs, like real estate, people in service, there's so much that you don't know, and really being open to expanding your knowledge and learning some of those fundamentals, like you said, of negotiation. I mean, that sounds fascinating, even for an accountant, right? Like I'm not even in real estate. So, I mean, I think what you do is incredible.
Thank you. I appreciate it. I mean, the body language one, actually, I got to tell you, of all of them that I do, it's one of my most fun ones because we don't do negotiations with 2 people. We do with 4 people. I have 2 people negotiate and they have a list of like emotions, and their job before the negotiation is to pick 3 of the emotions and just express it with body language throughout the negotiation. And the other person they're negotiating against is trying to pick out what 3 things they're expressing. The other 2 people are watching both of them and trying to figure out what the 3 things each one of them picks. So they're trying to pick all 6. And the reason why it's cool is because you now get an outside read as to whether or not the body language you think you're expressing is what people are picking up that you're expressing. And so it's not only a chance to see how good you are at picking up other people, it's how good you are at actually expressing what it is you want to express.
Right.
Like, oh, that was anger. I thought you were laughing, I mean, and it's interesting, the stuff like, really? And so those insights, I think, are really helpful for people.
It's so important. Oh, that's fascinating. So if people want to learn more about what you do, your courses, where can they find you?
www.closeforlife or acecloser.com, either one of those. Have a book out called The Roadmap, The American Dream, for those that are just interested in how money works. As it turns out, you can go get a 26-year degree in the United States of America. They will never give you one class on how to take and pay back that loan that they gave you to take all 26 years of education. So this was a book that just basically, I went back to college in my 30s. And just to see what I'd missed. I was curious, right? I came out of high school, I had businesses. I told you, I don't want to write any more papers. I'm going to go to college. Come on. So I went back to see what I was missing. I went in the right mindset. Like I just genuinely wanted to learn stuff and, lay it on me. I think I can handle it. Right. And it blew me away at the poor scholarship and just understanding of how the world worked.
Yeah.
And so that's what kind of laid the passion in my heart to take and write that Roadmap, the American Dream book. But right now I have a book coming out for salespeople. That's going to be, we're working on finishing that up.
Nice.
Called Close for Life. And that's very much what my business is about, that, running a business so well that you don't just close deals, you close customers for life. And the restaurant business is the same thing, right?
Yes.
I take care of you in a good way. You need that last minute birthday party and I move stuff around and I get you taken care of. Well, now you go from being that restaurant that we like to now you're that friend that I got in the restaurant business.
Yeah, exactly.
And those folks that just come back over and over. Those are the ones that pay the light bill. Those are the ones that take and get you through the tough times. And so, but the cool thing about that is, for me, is that when you truly do the work to close for life, that extra work to close a customer for life, it makes you run your business in such a way that that business goes from something that you do to earn a paycheck to something that you're proud to be associated with. And so that business is then an asset in your life.
Yeah.
So, I could think about how great my kids are at sports, all the things that people talk about to identify where they get their meaning in life. Well, considering how much time I spend in my business, I want my business to be in that category as well. And so the way that I run that dictates to a large sense how I feel about that, whether it's misery or whether it's something that I built that's worthwhile. So that's kind of it. So yeah, that would be, that's what the Close for Life whole thing is about. So if folks want to find me, and the other place is the Know Your Shit podcast, which is just, people need to know what the hell they're talking about. They really do.
Such a good podcast, by the way. I love your podcast. So
thank you.
Thank you so much for taking the time to speak with us today. It was a pleasure, and I wish you the best of luck going forward.
Thanks for having me, and it was really great talking to you.
Yes, thank you.